Good afternoon. I'm Jeff Hirsch, editor-in-chief of the Stock Traders Almanac, and this is WealthWise on Biz Talk Today TV. For my latest picks and market analysis, go to stocktradersalmanac.com. You can click on login, and there will be a link to a free trial. Before I jump into today's special featured guest interview with the irreverent Michael Gayed, there are a couple of market seasonality items on my radar. We are still waiting for our NASDAQ best 8 months MACD sell signal to trigger. It has been negative, the 1226.9 since May 30th. And our sell criteria is a new negative crossover on the 1226.9 after the first trading day of June. So we got to wait for it to go positive again before we can get a negative crossover. And with today's sell-off, the number is 1,092.17 NASDAQ points, or 5.62% for it to turn positive. And we are still holding our associated positions in the Qs and the IWM. Next week is the week after triple witching, which can be rough. This current sort of mid-June, late June consolidation we're seeing here sets up what we call Christmas in July, NASDAQ's 12-day mid-year rally, which could push the tech index to new highs. The influence of technology continues to grow. The market's focus tends to turn to tech Q2 earnings in the beginning of summer and the anticipation of the positive results. So the last 3 trading days of June, the first 9 of July are this 12-day rally. So it begins around June 26th, goes to about July 14th. And NASDAQ has been up 31 of 40 years with an average gain of 2.5% over that time frame. So just a couple, seasonal items to keep an eye on. And for more details and all that, go to, of course, stocktradersalmanac.com. All right, now let's catch up with my friend Michael. Michael Gayed is well known for his rapier wit and bold market commentary. He does not hold back and never sugarcoats it. He's a portfolio manager. He's the author of 5 award-winning research papers on market anomalies and investing. He's got a Bachelor of Science with a double major in finance and management for NYU Stern School of Business. He's a CFA charter holder and the publisher of the Lead Lag Report, which focuses on helping investors outperform in all market conditions with tactical, data-driven approach to achieve long-term success in the face of uncertainty. I have been on Michael's show many times, so it's my turn to ask the questions. I'm pretty pumped to find out what makes him tick. So let's go back to the beginning, man. First off, how you doing?
What was that? The term you used, wit? What was a
rapier wit?
Rapier. That sounds Shakespearean almost.
It is kind of Shakespeare.
Man, I like it. That's a good way to frame things. You know,
it's a little bit of a cliche, but we're having fun.
Yeah, no, I like it. All right, so you want me to go from the beginning?
Let's go. Like, where did your roots? Like, where did you grow up, man? Are you a native New Yorker?
I was born on the planet Krypton a while back. No. Yes, native New Yorker. Grew up in the business. So I think you and I have talked about this before, but you know, given that you've been in the business for a while, you know the name Bob Farrell. My father worked on his team, having immigrated to the U.S. from Egypt. My father found his way to Merrill Lynch, worked as a technician under Bob Farrell and a guy named Steve Shobin, who was relatively well known in the 90s at Lehman Brothers. I grew up watching my father in the business. He formed his own RIA, had a hedge fund, and long story short, the end point, which was to be a portfolio manager, I got there in a very odd and different way because I always was under the impression growing up that I will take over the family business, which was a registered investment advisory firm running large cap growth portfolios, again, the hedge fund. In 2008, my father passed. All those dreams and all those thoughts I had as far as what I'm going to do and what I'm going to be, you know, got thrown away professionally, personally, and then on top of that, the great financial crisis. But still found my way somehow to being a portfolio manager, just not exactly the way that I thought.
So, you know, I kind of fought the idea of getting into business with my father for many years. I kind of wanted to do my own thing a little bit, and a friend told me, like, "What are you doing? Go work for your father." So, what was where did it click for you? I mean, it sounds like you were into it all along. Like you knew you were going to do this. When did you realize that you wanted to be a portfolio manager like that?
Yeah, it's interesting, right? I I don't really know sort of where it came from. It did not actually come from my parents. I think my parents, as I look back in terms of the way I grew up, they weren't trying to push me to be into this field. But I thought it was interesting and exciting. I had a when I was 16, I worked on the floor of the New York Stock Exchange for an internship.
Hmm.
What was then, if you remember, Quick and Riley was the firm, right? I worked under
Yeah.
U.S. Clearing. I was in their what they call QT department, the questionable trades department, where it was a very interesting and gruff group of men, right? That were basically going back and forth up to the floor, checking on trade discrepancies. And I was 16, not knowing what the hell's going on, but it sounded and looked exciting, right? This is when they were actually traders on the New York Stock Exchange, not like now where it's just basically a studio, a shell of its former self. So, a lot of it I think came from that. I always had an interest in markets, in psychology and behavior, even growing up. I was the nerdy kid that would like literally read Edwards and McGee at the age of like 14, 15, right?
Wow.
And study technical analysis. And I even became known as sort of like the stock market guy, right? Internally at middle school and high school. So, it's like everything else, right? You learn by osmosis, and I think to some extent you get passion through osmosis too. My
Hmm.
father was very passionate about markets. He loved the business. He loved investing. He would always talk about companies and stocks, and I think it just kind of I got the bug.
Just kind of I think osmosis is a great way to put it. I mean,
Yeah, yeah,
I think in seasonalities, I think in the 4 year cycle, all these things, we had every Friday night, kind of why I do this show on Fridays is because it used to be Wall Street Week. We'd have dinner,
yep.
the kitchen table, and we'd be like, shh, Lou Rukeyser's on. So it was kind of growing up about that. When did you join the family business?
It was after I graduated, so 2004.
So you were already in there when when you suddenly lost your father, which was
Yeah, exactly right. So again, this was always sort of my path. All my other friends worked at it, ended up going to investment banking, right, and other investment firms or private equity. I always thought that this was sort of my direction in life, right? I'm going to come in, and I took it very seriously. I was among the top performing in my class for finance. I took management because thought I'm going to run a business. So let me learn about management. That was my double major, right?
right.
Um, Again, life throws it's like that meme of like, you think it's gonna be a straight line to get to your destination. In reality, it's like this, a squiggly. It's a technical analysis line, right? Yeah. So I never really sort of did the career route of working my way up at a large firm. I've never worked at a large firm. I don't know what it's like to work at a large firm. I've always been entrepreneurial because in many ways I had to be.
What was your relationship like with your father?
Mm. I think it's like everything else. Difficult in the moment, complex with hindsight, forgiving with time. Right.
I mean, I laugh because it sounds a lot like my situation.
Yeah, and I think a lot of people can relate to that. And I give a lot of respect to him. And it's like I saw this quote on X once, something along the lines of forgive your parents, they were trying to figure it out along the way, just like you
Yeah.
are, right? And it's like I can appreciate that as I get older, right? As I see I remember when I was probably, I don't know, 17 at the time, and I was in my father's office. And back then, people, as I recall, at least as far as I know, would actually smoke in the office, right? So you know, he had his 4 or 5 screens looking at markets. He's sitting down, he's trading, he's calling a broker. He's not doing online trades. He's actually calling brokers. Remember those days when you had to pick up the phone?
Yes.
And right, and I remember he said to me, wait till you see what it's like sitting in my chair. I remember that. I remember like yesterday. I remember him saying that, like looking me, and me not really knowing what's going on. I brought a Sega Genesis to the office to play NBA Jam, right? While he was trading because I didn't know what to do most of the time. It's like, okay, I'm learning, but I'm not gonna. What can I do? So yeah, it was complicated. I think it's complicated because maybe this is my own kind of experience as a first generation. I was born here in the U.S. Both my parents came from Egypt, Coptic Christian, which is in and of itself a relatively low percentage of the Egyptian population. Um, when you're a foreigner, especially back then, it still happens obviously, but especially back then, there's a lot of discrimination, there's a lot of frustration, there's a lot of anger. You're trying to learn the culture, learn the language, trying to establish yourself, and you're coming to America from another country for a better life, and that better life requires a much harder workload. It's like a resetting of your life, right? And I think like everything else, it it strained him, which of course then naturally strains those around you, children included, right? So, but with hindsight, like I said, I respect a lot of the things that he's done. I look back on a lot of things that I could not understand, and I can understand now why he would say things the way he would, or why he felt the way he did. Because, as you know, this is a very maddening business. This is a business. Forget about what you see on X and all this nonsense on social media. People that don't have any real skin in the game. This is probably the only domain, the only profession, the only career, the only industry in the world where you cannot draw a clear line between effort and result, which is maddening. Because no matter how hard of a worker you are, no matter how smart you are, it's not going to necessarily translate into better profits.
There's a little luck involved.
And probably a lot of luck involved, right? So to be able to operate in that environment, and again, as a foreigner, thinking as my father did, that like he's not going to work at another company after Merrill Lynch. He started an RIA. He had to trade through the 2002 tech sell-off, shorting tech and getting whipsawed on the short squeezes throughout that, and feeling that pressure when it's everything, it's your family, it's everything around that. I can understand how hard that is mentally now with hindsight, not in terms of how hard he might have been on me at moments in time, but how hard it was on him. And then the natural frustration that comes out from that to others.
So there was a moment for me when I started working with Dad a couple of years in, where we were sitting around a conference table. There was a bunch of the other newsletter writers and analysts there, and I forget exactly what he was explaining, but he was some new angle, some new seasonal thing he noticed, and he was telling everybody about it, and everyone was like, "Oh yeah, you're crazy," and I was like, I get what he's saying. That was like I clicked with him. Like I understood where he was coming from, and that was like the moment for me when I was like, okay, I can do the Almanac. I get this stuff. Was there a moment like that for you when there was something with your father that you learned from him that that clicked in your head?
Yeah, it's my father used to always say, I want to spend more time with you to impart all of my knowledge on you. Right. And I remember my father used to, that was like a recurring theme for him. Not that he was like, basically had an ego, right, about it, but it's like he wanted to transfer all of his experiences, right, onto me as his only son.
Right.
And he never got the chance to do it. And I think that I think the thing that clicked for me was the closest I have to that is his two books, right? The Challenge Generation, Beyond the Crash of '87, and then Into Market Analysis and Investing. It's like that's the closest I can get to being in his mind from a version of him from 1990, not from the 18 years past that, which had a whole bunch of different experiences. So I don't think there was sort of a moment that clicked for me in that sense. Although there is a moment I can point to in the video that I often will stream on X and on YouTube. That's a lecture my father did to Merrill Lynch brokers in the mid '80s. I happened to find the VHS tape and converted it digitally. And it's a clip of him showing a channel with, as if a chart. It has a chalk, right? It's got a chalkboard. He's drawing a chart. He's got a channel on it. And he says, it's like life. You go through higher highs, things are great, and then you go through a period in your life where things are not going well, but it's still higher high. And that's the channel, right? And he was basically making an analogy about sort of the ups and downs of life, through a chart. And to me, that really resonates well because who doesn't have those periods? I've had a lot of those dips, right? And all within
Sometimes within one day.
Yeah, of course, right. Which goes back to the maddening part of the industry and living the life that we live, right? So that those are the things. It's there was never sort of like with you there was the aha moment. I never really had that aha moment because unfortunately time took him away too quickly.
So that was a rough times, big shock. You bounced back. Like, how did you do that? What was your next move? In '08.
Yes. I got my CFA charter in '08. It didn't matter. I remember the stories back then. I'm sure you do too, where it's like, you had Goldman Sachs HR people that would have a stack of resumes. This is literally the kind of stories that were going around back then. And they would take that stack of resumes and take the first half of those resumes and throw it right in the garbage. And the reasoning was they didn't want anybody who was unlucky to hire, right? In the midst of the GFC unwinding. So it's like, I got my CFA charter, my father passes, the family business closes. The hell am I going to do? Right? It's like, it's the end of everything that I've ever known or thought or whatever it would be. So, and I had applied to probably 5,000 jobs in 09. Who the hell is going to go talk to Michael Guyot or interview Michael Guyot, this kid that nobody has ever heard of, right? While you can get a CFA charter holder who was laid off from Morgan or Lehman or Merrill, anything, right?
Right.
So I thought, all right, let me take the nuclear option. The nuclear option is, let me get an MBA. Let me literally reset my life. Let me do what my father did. Reset everything, right? And find a new career. I was at that mental point. The same day I got a job offer not a job offer, same day I got into Cornell, the Johnson School, which is the top 10 MBA school. Right. I got a job offer with a family office that was based out in Geneva, but had the satellite in New York.
Okay.
So it's like, all right, well, I'd rather make money, right, than do the MBA. Yeah, and if I can keep the nuclear option on the MBA, let me keep the nuclear option, right? So decided to take that. It was literally the same day. I was about to do the yes on the Johnson School, and I got the offer. So I ended up working for a family office for about a year. So $2 billion family office. They had about, like I said, $2 billion. Yeah, interesting family dynamics. It's like managing just one client. Right, that's what a family office is, with interesting political dynamics in terms of the patriarch and then the kids and who's trying to get more of the money, all this stuff. I like the situation actually very much, but I decided May 6, 2010, if that date sounds familiar, that I had to leave.
Yeah, there was a certain event that happened in the market.
Right. So I was basically managing like effectively a prop portfolio for the family office. It's like I get a percentage of profit, like a hedge fund with just them.
Did you leave before the flash crash?
No. So the family was very adamant against shorting, which is funny for me to say because I'm adamant against shorting now, right? And I'm very public about that as a tactic. But on May 6, 2010, I was in a panic because I believed deeply the stock market was going to crash that day. And it's not one of those things where it's like I was calling it for weeks. There was something specific happening that day that I said, we're going to crash today. And I essentially what happened is prior to the Dow going down 1,000 points, May 6, 2010, the flash crash, junk debts was down like 5-6%, which in credit markets is a 1987 style crash. Right. And it's like it's a multi-standard deviation, shock. Right. And the bond market led the stock market that day. I've actually written about this because a lot of people say it was because of spoofing, or I think they blamed some kid in the UK that was, somehow.
The London whale or something.
Yeah, right. It was nonsense because the bond market, there was something going on with the bond market 2 hours before. I can show you the chart where J and K HYG were down. It's like effectively a crash in the junk debt market. Right. There was no liquidity in bonds. Now I saw that and I was in a panic, and I like a portion of my earnings come from managing this portfolio. So I called up the son of the patriarch with the family office. I called up the father himself. They were in Geneva, 6-7 hour time difference. I said, I'm begging you, let me short. I'm begging you today, let me have puts. I sent emails. I still had them with timestamps saying we're going to crash today. And market crashed. And I couldn't do anything about it because they refused to. They just didn't want to do shorting. They wanted to be long only. The day after, they said you were right. So they asked me, what did you do about it? I said, what do you mean? You literally told me, I have emails. You told me don't short, don't do puts, don't do anything. What was I supposed to do? You wanted me to stay long only. So that was my wake up call. It's like, all right, I don't want to just have one client, and if I'm gonna get compensated based on my beliefs and my actions, I have to have freedom to express those beliefs and actions, right? So after about a year left them, it was that year, later that year, I synced up with the only investment advisor that I had interned for while at NYU, for a firm called Pension Partners. And basically said, listen, I have this experience. I'm young. I'm hungry. Let me see if I can build up your separately managed account business. And then there's a whole bunch of backstory there, but that's sort of the transition was from 08, let me reset my career, getting the family office, May 6th flash crash as sort of a turning point for me to say I can't do this and be just beholden to one client, to then going into the investment advisory world all over again.
And now, is that where you connected with Charlie?
Yeah. So I launched the mutual fund ATAX in 2012, risk on, risk off. literally the day of QE3, September 10 or 11 of 2012. Now, I launched that mutual fund because I was getting a lot of big calls right on markets, on Seeking Alpha. It was in the media a lot. It was writing on MarketWatch at the time. And I remember there was a time on MarketWatch where I have email proof of this. The editors said that internally within MarketWatch, because I was so on fire on market analysis, they called it Gaiad Watch. Like I was literally driving page. I'm not saying it with ego. It's just fact. Like I was driving page views because I had the hot hand for whatever reason,
Right.
the way I was thinking about things, and that translated to assets for the fund. But you know, I'm new at the fund management world, and I realized somebody has to be on the road selling. Somebody has to be on, literally being the one-man army to financial advisors. Here's why you should allocate to my mutual fund. I needed somebody else while I was on the road doing that to continue the voice and the content. Charlie Bolello, who I haven't talked to in a number of years, I always have a lot of respect for him. He was the guy that basically came to me and said, "Listen, we think similarly. I'm looking." He literally just from an ex Twitter DM met up with him for drinks, and that was it. Basically, brought him on. He would then acted as the director of research, where he did a lot of content, and I was able to help elevate. I think I was able to help elevate his name, although he obviously, he's got great content, so he didn't need me for that. But he was basically meant to sort of be my replacement in terms of being the voice of the firm, so I could just be literally grinding, traveling every week, presenting at CFA chapters, doing that very hard sales life.
So that fund is you're still managing that, right?
Yeah, and so the still managing that mutual fund. The mutual fund never really had any outstanding performance because of two factors. One is if you're in a cycle which is pure risk on, pure up and to the right, a risk on, risk off strategy doesn't really work or stand out because you need to have some periods of risk off that are sustained to benefit from the defensive posturing that otherwise you will get whipsawed from naturally, right? When you're tactically trading.
Mm-hmm.
But the other side of that is that if you're in an environment which is purely about large cap momentum, and you're trying to, when risk on, play small caps or play emerging markets, which the mutual fund tries to do, if you're in a cycle where there's no tailwind for those parts of the equity landscape, you also get whipsawed, and you're not keeping up with the S&P. So I kind of got hit with the worst of all worlds. The launch today of QE3. QE3 is when you started almost having a 1990s style melt up in equities. It became purely about S&P large cap. No risk off, you get whipsawed. Small caps get whipsawed. Emerging markets get whipsawed. So no real strong performance. Now in 2020, when I brought the fund over from Pension Partners, the RIA, to Title, then Toroso, now Title Financial Group, renamed. In 2020, that mutual fund was up 72%. Why? Because I had the risk off. I had the COVID crash. The fund was basically in long duration treasuries mid-January of 2020, stayed there throughout the COVID crash. Treasuries are making money as yields are collapsing on the deflation end of the world scare. And then a week after the low, March 31st, it goes fully risk on into equities. It was almost the perfect sequence, right? So funds up 72% by end of 2020. I myself raised about $330, $340 million in the span of 13, 14 months. No wholesalers. Again, this is the life I was doing for so long, being on the road every week, presenting, talking to advisors. And by the way, anybody that has not lived that life, that is a hard life. Like I have so much respect for these traveling, wholesalers. That is not easy to be on the road and eat healthy and maintain relationships and try to, all this stuff. So I thought that was my breakout moment. It's like after all these years of struggling in a nasty cycle which didn't favor active tactical, not just for me, but hedge funds and other tactical strategies, I finally had my breakout moment. And then here comes the fastest rate hike cycle in history.
This is where we started talking. You're talking about 22.
Yeah, so I go back to, you need to have an environment where it's risk on, where small caps persistence is there, or emerging market momentum persistence there, but you also need to have risk off. You need to have junctures where your treasuries counter equity volatility, especially on the long duration side, which had been the case up until your point, really 2022. So in 22, here comes 2022, what, third worst year for 60-40 or among those, right? I think whatever the stat was. Worst bear market for treasuries in history, worst sequence for treasuries, sequence meaning a number of weeks down, which we can talk
That's where everyone started talking about 50, 30, 20 getting in.
Yeah, right. And I remember there was a post I put out that went viral in 2022, where I looked at the CRISP Center for Research Security Prices data on 20-year Treasury indices, which is basically what a TLT type ETF tracks,
Yep.
and the S&P. I looked at, okay, go back to 1961, as far back as the total return Treasury index goes, and look at the top 20 biggest drawdowns for the S&P 500, top 20 biggest peak to trough declines for equities. How did Treasuries do during those major drawdowns for equities? That drawdown from 2020 to whatever it was, 2020, the end of middle of 2020, 2022, was the only top 20 drawdown where Treasuries were down more than the S&P 500, and Treasuries are the risk-off expression. And I'm by mandate in the prospectus, I have to be in Treasuries when risk off. Same thing with my ETFs, RORO and JOJO, which I launched 2020 and then 2021 respectively. They're different signals. They're all variations of this concept of offense, defense, all in, all out. But the commonality isn't the signals. The commonality for the risk off is that they all use Treasuries. So all of my funds have done terribly because you've been in this cycle where Treasuries have not acted like they historically would under a traditional risk-off regime where volatility in equity spikes, and there's a flight to safety in Treasuries. And a large part of that is because you have seen credit spreads continue to narrow, no real credit risk rising at any real significant period for any significant period of time, to allow for that flight to safety in Treasuries, that sequence to allow the funds to also stand out, to actually work instead of being whipsawed.
What about the short-term Treasuries with all the rates up so high?
Yeah, so the mutual fund did play that. RORO and JOJO, though, because those are index rules based, they did not go in short duration because the indices that they're trying to track are designed to just be long duration. And so you can argue it's a design flaw. I don't believe that's the case. I mean, I never imagined you'd be in the worst environment possible for a long duration in the way that it played out. So this is what I alluded to, is something which I think is underappreciated. 2022 was abnormal, not just in that Treasuries, bonds, and stocks both fell hard. It was the way that they fell hard, the sequence, the path, not just the endpoint. I had referenced these stats as I recall, but if you were to look at the number of weeks the S&P 500 was down in 2022 as a percentage of the year, number of weeks down, red, as a percentage of the year. The only other year in history where you had that number of weeks down as a percentage of the year that you had in 2022 was 1931. So it was the second worst sequence in terms of consistent decline ever. When you looked at Treasuries, was the number one year, meaning you never had a year in the Treasury Total Return Index where Treasuries week after week after week after week were losing money in that type of a consistent pattern. Now, when you're active and tactical, that matters. Because if you're trying to rotate based on weekly sequences, damn if you do, damn if you don't. You could have right. You could have had a situation where both were down by 2022 at the end of 2022, but maybe stocks were down in the first half, and then Treasuries were down in the second half. It was the parallel stair step down that was what was killer.
I think we spoke about it back then. There was an observation we made that the Fed was different now. Was different during 22, and even still is. Where they started to go back to the old ways, where they were trying to dictate to the bond market what it should do, as opposed to being a guardrail. There was a quote that I pulled out from like 81 from Volcker saying, if the bond market goes up, the rates go up out of the range of 15 to 21% back then we'll make some adjustments. Whereas we were in a period of the Fed trying to drive the bond market instead of, guardrails. So I think that may have been part of the problem. And still, I think we're getting away from that a little. I think I'm listening to the bond market some, but I probably need to listen to it more.
Yeah, and I go back to, and this is what's been so bizarre about the cycle, and perhaps is what I missed. And even for those that say, oh, you're a perma bear because I keep talking about a credit event and stuff, right? Which is like silly. I can't be a perma bear because I also need the risk on side. Like the idea is you're avoiding a drawdown in equities by being in treasuries during the bulk of that drawdown. Then you're going back in equities at a lower level, like the 2020 playbook. That's what risk on, risk off needs to be. But what I missed in this cycle, which was mind blowing with hindsight, is that okay, fastest rate hike cycle in history, and yet credit spreads keep tightening. Well, how does that make sense? Well, it only makes sense if, while on the one hand they're tightening, they're on the other hand stimulating, which is exactly what Yellen was doing with playing with the Treasury curve in terms of the issuances. So
with the QE.
Right, exactly, which exactly right. So and in the regional bank crisis also gave them cover to do that too, right, from 2023. So it just created this massive distortion, which is why it looks like you have this weird disconnect between the credit markets And then small caps, which is a whole different discussion but related. Small caps saying there's default risk, credit markets saying there's no default risk, fastest cycle in history. At the same time, Treasury's countering the Fed.
So you're coming out with some new stuff right now. I want to get into that, which I think it's comes from what you've learned with this crisis here. So we never got your credit event. We never got the debt crisis. Are we ever going to get one of those? Is that over? Are we moving on?
I am. I'll tell you in a few years. I don't know. Look, I believe the reverse carry trade dynamic, which I always thought was the catalyst, is still out there.
Mm-hmm.
I think it's just playing out slower than I myself anticipated. The idea that Japan will panic, all these things that I say, which are related to the yen, oil priced in yen, this whole thesis I've had for the last 2 years, I still think that's a really underappreciated tail events condition. Okay, and we saw a glimpse of it August 3rd and August 5th, right, of last year. But I still think that's out there. People that will say the carry trade is not a catalyst or it doesn't matter anymore, I don't buy that because it must still be happening because it's still profitable. The idea of borrowing from Japan and deploying it elsewhere, borrowing it at a much cheaper rate because the BOJ doesn't want to hike rates because it's hard for them to do so, while the long end has basically lost, has gone bonkers with Japan. So I may have been wrong in the timing of the credit event thesis, but at the same time, something is off with Japan. It's very obvious when you look at their bond market now. Like I wasn't that far off, at least from that, like identifying there's something wrong here.
I mean, there's something's happening with the U.S. bond market
too,
as
right,
well.
Exactly, right.
I mean, there's a move away from the world buying U.S. Stocks, and we've got this deficit issue. I'm still amazed that we didn't refinance our own debt back in COVID like the rest of us did.
Yeah, lock in 100-year
mortgages.
treasury. Yeah, of course, right.
I mean, where was the 50 or 100-year bond at ZERP? I don't know.
Wow, that's why you always have to be careful about conspiracy theories around the government, because that assumes that the government's competent. It really is, right? But so okay, so to your point, okay. So first of all, I do believe that the risk is still out there. I think it's still underappreciated. I recognize the timing has been off, but this is the thing. This is why I go back to why I'm now very loud at saying don't short. You can still be bearish and still make money, right? By being long only. Perfect example of that is gold. Okay, so I've been bullish on gold up until, at least conceptually, really up until maybe 2.5, 3 months ago. From October of 2023, when I was most bearish on a credit event happening imminently. Why am I mentioning gold? Because gold is a risk-off asset. Gold has been in an incredible bull market, really since then. Right now, why has gold been in a bull market? I would argue because there's big money. There are allocators that are saying, I don't want as much correlation to equities as I had before. I can't short as an allocator. How do I lower my correlation by being long only? There aren't that many options. Gold happens to be one of them. So I think
what are the other options? Bitcoin, crypto?
No, well, Bitcoin. I think Bitcoin at some point will be not yet, right? But I think at some
Still
point
tracking the market pretty much.
still
right?
tracking the 3x Nasdaq as Tavi Costa, who have
right, or 4x. Yeah,
right, exactly. No, I mean historically, it's also the dollar, right, and utility sector, right. It's like those are typically your quintessential defensive plays, and then treasuries would be the fourth one. But again, treasuries have been clearly the loser in this. Now, on that point, when the tariff tantrum started taking place, it looked like treasuries were coming back as a flight to safety trade. Meaning, as equity volatility was rising, we started seeing the whites of the eyes of that behavior coming back. Treasury yields were at least not rising and at times falling as stocks were falling. It looked more like classic risk-off behavior, which gives me hope that it's coming back to life, right? And maybe this wasn't enough, but I still think it's out there. So yes, I still am negative from that perspective. I say I'm not. It's not that I'm bearish on stocks. It's that I'm bullish on a tail event. That's a moment in time, though. I believe the real long-term secular argument or thing to really pay attention to is deregulation, which relates to fund launch.
Yeah. So let's talk about that since you brought it up. You moved out of Title. You're still with Title, or you got a new RIA? What's going on there?
Yeah. So I formed my RIA end of December. Still working with Title because they're still the advisor on my funds, and I actually just spoke with the co-founder the other day. So very much still working with Title, but just in a more traditional clients type of dynamic. And built up lead lag media, lead lag publishing to a very substantial number. So 3 business lines, my funds, my lead lag report, and then this agency that I built out working with fund issuers. Almost the entire industry is working with me in some way, shape, or form. A lot of the content that people see from other fund issuers, it's probably actually from my team. They just don't know it. There's a lot of interesting things that on the back end I've been quietly building, right?
Nice.
But the on the deregulation side, so is going back to your point about what did I learn? The thing I learned, which admittedly maybe I learned late, okay, is that in the fund worlds, you're not really a portfolio manager. In the fund world, you're really a product developer. This is a very different mindset than, I'm managing stocks and bond report. No. You're actually trying to create a strategy for a particular environment that your fund is designed to benefit from, right? So I said to myself, okay, so deregulation is going to be a theme for Trump. Let me approach this like a product developer, and let me approach it like a VC type of investment where I'm going to bring in other partners. We're going to split the economics. We're going to be, portfolio managers, but all in this product together. And let's build out a real investment process. It's very different than what I'm doing for my tactical ATAC funds. So I got 2 other sub-advisors, Point Bridge Capital, and then Sycon Asset Management. They're both RIAs. Title is the advisor. We are the sub-advisors, my RIA in those 2. And basically for the last several months, we've been building out an AI system that looks at legislative actions, executive orders, speeches, various sources of government information, synthesizes that, focused on deregulation. Then the other side of it, we look at and screen for companies in highly regulated sectors and industries, for those that have strong operational efficiency, for those that have interesting revenue growth historically to show that they can grow despite red tape. With some technical factors like, is it above a 200-day moving average? What's the relative strength? So not risk on, risk off, but still some technical aspects. And then we tell the AI, okay, which of these companies likely benefit the most from deregulation? So I'd say like 80% of the investment process, right, is AI driven. We still meet as an investment committee, go over the positions, make sure everything makes sense logically, right, and with our own analysis. Now, first ETF of its kind that tries to do this. Ticker is FMKT, Free Markets ETF. I'll be very public about it. I didn't know if in launching this I'd be seen as damaged goods. And what I mean by that is my mutual fund, my RoRo ETF, my JoJo ETF, horrible cycle. They all have to be in treasuries when risk off. Long duration for RoRo and JoJo in particular. And performance has, it looks like it's coming up for my mutual fund, especially. It's up 10% as we speak, but JoJo too, but not up that much. But I'm saying up strongly. I thought, okay, well, people are going to say, oh, here comes another crappy fund guy it comes out with. Really, and it's my own anxieties, my own fears, right? Because I have been so beaten as a fund manager in a cycle I could not control, launching my strategies that rely on treasuries as a risk-off option in the most imaginably worst cycle in history, right? Our people and of course everyone blames me. You suck. It doesn't matter that the existing tactical funds are rules-based. They would run the exact same way if I die tomorrow, right? It's me. It's my face. So it's like, guy, it sucks. It doesn't. So my fear was that I'm going to launch this FMKT deregulation ETF, even though it's totally different, not tactical, AI-driven, and people are going to be like, oh, here's another fund that's going to suck. So I didn't know what to expect. I didn't really talk about it that much to that many people. So we launched it June 10th, that Tuesday. It's like the Ray Bradbury quote, whatever it is. It's like, the best way to know to manage risk is to jump and then build your wings on the way down. Right? It's like that kind of thing. So day 1 hits, not knowing what's going to come, and then suddenly, it has 493,000 shares traded, which for a thematic equity, large equity ETF, I say largely because it's got gold and Bitcoin in it, has free market expressions. For a thematic fund is almost unheard of. I mean, I was having other fund issuers, because they work with me, prospects and existing clients, saying, where did that come from? Because they all know how hard it is to get that kind of interest out of the gate.
How many assets are under management?
So as we speak, we're the June 20th now, where I think it's with the pending creates is my guess, pending, meaning it's not actually, shares have not been created yet. It should be around, I think it's around probably 14 million. With what's there, it's 11.5, which, for something organic out of nowhere, is actually
So
a success.
I looked at the holdings,
Yeah.
some interesting stocks there, some stocks that have come through my screens. We do a fundamental technical. I do like the additional AI, regulation wrinkle that you put on there. It's about what, 45 holdings the other day. How often are you changing the
Yeah.
positions? How frequently are you rebalancing or moving things around?
That's the big unknown because it's very hard to backtest something when it's evolving and dynamic, right? So, because Trump comes out with executive orders on Fridays, he might do one as we're chatting, right?
Right.
So it's not clear sort of how that's
And
going
then
to.
he could get sued to,
Right,
stay.
exactly right. They could go back and forth. Exactly right. So then that's why there has to be still some human oversight in terms of what's being chosen, right, by the AI side. But the answer is I don't know. It has to be active, clearly, right? So and it is active. We actually just added Archer Aviation and Joby. Okay, why? Because of the FAA, relaxation of rules on the executive order from like a week ago that Trump did, and those are flying taxi plays, right, and drone plays, airspace plays. So like it's that kind of dynamic. We don't know just yet until we go along. I suspect my guess is I can't base this off anything, so don't quote it, but it's probably around 30-40%. It's probably going to be how active it is. If suddenly a large number of stocks in the portfolio are in a deep downtrend while others are in an uptrend, we'll likely sell those because again, we don't want to also be in deregulation plays that are just losing for this, because they have to be deregulation plays. There are always other deregulation plays to go that might be in an uptrend. So we'll see. It's a big unknown, but I do know that we do have a first mover advantage and we have the system in place.
The website looks pretty cool. I like the big ball.
The bow with the red, the ribbon, the red tape.
The ribbon, yeah, but
Oh,
it's
the
like
idea,
come,
right?
yeah, yeah. So I think it's interesting. You know, you have a lot of signals with the existing funds. I assume you're still running those. You
Yeah,
think
yeah.
they get about what are the signals that you trust the most?
But there's no question it's the utilities trigger.
And
That
that's the JoJo fund.
that's JoJo, right? And also the mutual fund ATAX plays the utilities trigger as well. So it makes sense. That's why ATAX is up 10%. It's actually done pretty well. It's navigated this tariff tantrum pretty well. The reason I'm saying utilities are probably the most accurate now is because it's not being thrown off by tariffs, which is unfortunately what's happening to my RoRo ETF with lumber to gold, where tariffs are impacting the price of lumber, which impacts the risk on, risk off triggering of lumber relative to gold as an offense defense dynamic, right? That will change at some point. I don't know when, right? But I think utilities still remain, and actually, if you look historically over the last several years, utilities led in advance of every single major real decline in equities. Utilities bottomed
So,
relative to the S&P November 2021 before the
so tell me about these two signals. How does the utilities market signal work? What are the factors? What are the plugins?
Yeah, and listen, I know you know this stuff better than anybody. Also on that end, it goes back to the 2014 Dow Award intermarket approach to beta rotation, which Charlie co-authored with me, Charlie Bolello. So basically, the finding is you go back to 1926. Usually, when the utility sector is outperforming up more or down less the broader market, typically with a lag, you'll see stock market volatility rise afterwards. On average, is the key term there, right? Over a long enough sample. So utilities tend to move in advance, right, relative speaking, of high risk environments. You look at the top 1% of VIX spikes, utilities are already leading before that, right, historically. Again, not my opinion, just fact. So, and now why is that? Because utilities are the most bond-like sector of the stock market,
Hmm.
right? So if we agree that bonds lead stocks, then it makes sense that utilities lead stocks as a proxy.
Is there any possibility that the huge energy requirements of AI in our new world are helping utilities
Yes.
aside from this ratio relationship?
I think there is something to the idea that it makes it not as pure as it used to be, right? As a defensive play, right?
Right.
That's why you need to ultimately, it's like the best situation would be that's happening while treasuries are strengthening. The two confirm each other because that would be more of a defensive tell, right? From that standpoint. But, I do think that muddies things. I don't think it explains, the majority of the movement though still. I could be wrong, right? But it
So
says it's not.
and then what about this gold lumber ratio? I mean, what is the relevance of that? What does it tell you? And
Yeah. I
how does
mean,
it?
I'm sure you know the copper gold relationship. The idea is in copper's industrial, gold is safe haven. Well, this is like that, but when it comes to housing, right? Lumber it makes up is framing of housing, and is lumber is actually very correlated to housing starts historically. So if lumber is doing poorly, the idea is that, well, housing starts are likely going to drop, construction is likely to drop. That has all kinds of implications on the broader economy. You compare that against gold as a safe haven. Historically, it actually is pretty good at telling you about risk on, risk off dynamics, except in this cycle. Not just
because of
because of
tariffs.
tariffs, yeah, because not just because of tariffs, but also because you had this distortion with the post-COVID sort of buildup of everybody wanting homes and all the remodeling. It just there's a lot of one-offs. I know that sounds like an excuse, but I think there was a very anomalous type of behavior that's explicitly impacted lumber, which threw the signal off.
We saw that housing price boom, in the outskirts of New York City, where I live and my office is incredible. What's going on? I mean, I don't know how kids are going to buy a house, in the suburbs anymore. They might have to move further out,
Yeah.
Pennsylvania.
Now, I will say there is an interesting connection between deregulation and risk on, risk off. Okay, so and this is I don't this I'm not trying to make a connection to make the connection, but I think it intuitively makes sense. Okay, what is the most regulated sector of the stock market? It's utilities. What's the least volatile sector of the stock market? Utilities.
Please.
Okay, so I can't prove it, but I suspect it's the same reason why Bitcoin is so volatile. It's the freest of markets. I suspect that there is a link between high regulation and suppressed volatility in that sector that's regulated, which means conversely, lower regulation probably means more volatility. And it kind of makes some sense because if you don't have as much red tape, you have more disruption potential by competitors. If you have a lot of red tape and a lot of compliance costs, the incumbents stay in power and it's reliable, right? So volatility is suppressed. So why am I saying that? Because if I'm right about the very long-term idea that deregulation, is going to have all kinds of profound implications, it probably means we're going to have more volatility on average anyway, right? Across all sectors, right? Because it's going to hit all sectors, some more than others.
And
So
that volatility isn't necessarily bad.
no, it's not. And if you're an active tactical trader, it could actually be great. And it could, that's my point, it could bring back more traditional risk on, risk off dynamics, which would then, as an environment, I hope at least, benefit the tactical funds, which, when they have a cycle like my mutual fund did in 2020, it tends to really rocket. But you need to have that spread widening. You need to have that stress in the markets for a moment in time, right? To then play that sequence. But my point is, I think deregulation could actually be one of the catalysts that, oddly enough, helps the existing funds out, separate from FMKT.
So you think this is part of the new investment model world, or I mean, you still got the old funds with the old tactical strategies existing, and you got this new thematic thing. Is the old stuff going to be dead, or you think it's going to come back, and how do they all fit together?
No, I mean, I'm clearly hoping that they come back. It's like you always have to ask yourself, again, going back to the fund business, right? It's like, would you launch a strategy which hasn't worked for the last several years? Would you launch it now?
Hmm.
Right? It's like the calculation isn't sunk cost fallacy. It's like, would you actually launch the strategy here? Because the cycle may be so old and maybe about to turn. And like I would launch, of course I'd launch the funds here. I just went through the worst bear market for treasuries and risk off in history. With that as the expression of risk off, of course I'd launch it here. Now, the key thing, of course, is having the liquidity and staying power, because what's missed by a lot of the knuckleheads that attack me for this is it costs at least $250,000 per year to keep a fund open. Like, this is not some like trading account. Like, as a business, it is costly to keep this thing open, to keep Roro and Jojo, which are not break even, open, right?
And in order to break even with that kind of cost, you got to have a lot more AUM.
Right, and to get a lot more AUM, you have to have performance. This is what's missed by all these people, that they don't know what they're talking about. And,
From my experience, if you have less than 50 million or even 100 million in a fund, it's not sustainable.
especially when you have a whole army of wholesalers and people you got to feed, right? And in my case, I'm fortunate that I've got the content and audience that I can convert it myself, right? It was why I'm always so busy, right? Like, I have to do so many things because I can't afford hiring other people, even if the performance is hot, to really sell it. So no, I'm keeping the funds open because I'm optimistic that I think the cycle is due.
Overdue, arguably.
Overdue. And again, it's not, I don't necessarily have to have anything like a COVID crash, but any kind of real spread widening would do it. But even if you don't have spread widening, again, the second part of the deregulation thesis is that it levels the playing field between large caps, mid caps, and small caps more. deregulation as a concept should benefit smaller companies more than larger companies, because they're the ones where more of their margin has to go to deal with the red tape.
Small caps aren't going to do anything until this tariff stuff's decided.
I agree, but I do think you have to ask the question: why is it that even with the tariff stuff undecided and with rates higher, small caps seem to be acting better on a relative basis? Like they're not collapsing
In the real short term.
In the very short, yeah, exactly right. In the very short
since April 8th, but going back to 21,
yeah, terrible.
It's horrible. I mean,
it's halfway through a lost decade. I mean, that's the reality for most small caps. That's why it's like those people that are like, "Oh, you've been bearish all the time." It's like, yes, you look at the number of stocks that have gone nowhere since 2021. I'm just going to pure number, not market cap weight, just number of stocks. It is fact that the majority of stocks, especially after inflation, are still deeply in their drawdown. Like it has not been a bull market that's a traditional bull market in the way that most people, like the idea of a rising tide lifting all boats. Like what rising tide? It's literally like two different markets.
Yeah, it's a lot like the old Nifty 50 days in the 60s. I mean, but there is a lot of speculation out there, especially with Bitcoin up at 105 or whatever it was today. I mean, I see you got the IBIT in the new fund, which is my favorite. Grayscale before that was pretty good, but you think are you concerned about all this mania, this speculation, all the leverage out there, or
of course? Yeah, I mean, look, it's got Bitcoin and gold in there, but Bitcoin, just because it's in there now doesn't mean it's going to stay there. This is the active side, right? So, like, if suddenly Bitcoin enters some massive, downturn, we're out. That's the benefit of being active from that perspective. There will be other free market plays besides Bitcoin to replace that with for a moment in time, right? So there's still going to be an active trading component of it. But to your point, and actually, that's if you really want to make a bearish case, the bearish case is very simple. This drawdown with tariffs and the viciousness with which it came back emboldened investors and retail, I think, in ways we have not seen before. Because if you look at the flows, it's all gone into levered funds aggressively. It's all leverage, right? So there will come a point where that does create a crash. Like I've used that line many times before, and you even argue that part of the reason why the tariff tantrum was so sharp was because the starting point of all this tariff stuff was extreme leverage to begin with. Nobody was prepared, and everyone was levered from a lot of perspectives, options and levered ETFs. So I've used this line many times before. Overconfidence leads to leverage. Leverage leads to crashes. Overconfidence comes from recency bias because you're always right with every single time you, in quotes, buy the dip. So every time you buy the dip, you're right, which means what? Well, I mean, if I was right before, then I should lever it up more. Oh, and I got to lever it up more, lever it up more, lever it up more. Okay, well, at some point, you're as extreme as it gets. And that's when it really gets to be very ugly. That's where you have the margin calls where it is the event.
Where does my favorite cycle fit into your thoughts here? The 4-year presidential election cycle.
So you tell me. So as I recall, this is still it's not a killer year, right? But it tends to be an okay year. I think the second year is the worst, right, of the 4-year cycle.
Yeah,
right.
22 was a very typical midterm election year bear market. Right. I think Trump's days are numbered to get things done with the midterms coming on. I think he's got through the end of the year. January, they're going to start campaigning. I'm not exactly sure. Nobody is how the midterms are going to turn out, but historically, generally the incumbent party loses some House seats and loses control, potential to lose control. We had a textbook October midterm bear market bottom in 22. It does set up the sweet spot of the 4-year cycle. I think this is the post-election year has been historically difficult for Republican administrations because they come in and they take care of stuff quickly, and they're doing a lot of that right now. And my charts, analogs to post-election years, it's got it at the sort of weaker, level of things. Yeah, we're getting back up to average, but we're up only a couple of percent in the S&P. Didn't do the math on where we closed today, but we were off a bit. So I'm still 50-50 for this year, base case, worst case, flat to negative versus, low, high single, low double digit type gain.
And I think it's probably the most frustrating scenario, which is probably the one that happens, is that the S&P goes sideways. It just frustrates bulls and bears. It's like you don't make new highs, you don't make new lows. And we say it's very possible. Now, I would say though that small caps could diverge from that. Mid caps could diverge, meaning you could see those actually areas be where all the action is, right?
What
While
did that tell you?
sideways. Well, it would argue again. It goes back to I think you would argue that deregulation is maybe one of the reasons, but I think it would tell me that we are in a bull market for the market that never participated.
Isn't that sort of where the end of the the big bull comes in when the small caps start to rally?
Yeah, yes. I mean that's so which again goes back to why has there been so much accumulation of gold? Because there's got to be a cycle bet there.
So, what's your take on Trump?
I don't know, man. Sometimes I feel like we're all dead, and this is like some like weird afterlife simulation. Right? Like it's like
Some Stanley Kubrick movie or something.
yeah, it was like I think it was like the last season of Lost was like sort of the realization of that. Right? They were all dead all along, and anyway. Someone is calling me on Ring Central. We'll cancel that. Okay, so I don't know. I'm neither a supporter nor a fan, nor a hater, I should say. There are things that he does that I agree with. There's things that he does that I don't agree with. And by the way, it's weird to me that people can't think in those terms. It's like you're either all for him or you're all against him. So you're all for Kamala, and it's like this is silly. Like have some nuance.
There's nobody's nuanced anymore.
Because everyone's a dumbass. I'm sorry to say it, but it's like let's be honest. I mean, a lot of people. You probably saw that study. It's like they looked at brain activity for the most active Chat GPT users. They're getting dumber. Like I joke about it.
I'm using it smart.
No, yeah, right. You might be the exception, but I'm saying like the reality is like as a one of my most engaged posts recently was is it me or is incompetence levels are they at all-time highs? It just seems I don't know about you, man, but it seems like there's just this weird dynamic where there's so much incompetence and it's like almost like you can't believe what's happening around you. And I feel like that with Trump. Like you can't believe like for God's sake, we just went from Musk saying that he's basically a pedophile with the Epstein stuff.
And now he just did a deal in China for something for the batteries.
Like, are we like? Can we actually take a step back and just be like, what the hell is happening?
So is this where the few come from?
If you understand it, it's like I don't understand it. I'm among the few. I don't know what to tell you.
Who is the few? Who are the few?
Yeah. So the real backstory on that is real quick on that is in 2020. I think it was in 2020. I was just pontificating randomly when I was being much more serious on X about Bitcoin and the idea that it's indivisible and liquid, right? It was finite and liquid is what I said. And I was like questioning because it didn't seem to make sense to me at the time. And suddenly all these Bitcoin maxis were like coming at me aggressively. And they kept on saying the Bitcoin maxi term, if you understand this. So I basically had a moment in my mind where I flipped. I'm like, okay, you guys want to come after me when I'm just actually trying to genuinely have some kind of open conversation on social media, which was my mistake to begin with. I'm going to use few understand this on every single post, right? Few, if you understand this. But then there was something else about the persona and the act on X. I know that the algorithm likes when the authors of the posts are engaging, right? Replying to other people's replies.
Right.
I don't want to spend my days literally just like writing these long sentences to people responding to my posts. So it's like, how do I game the algo while being more efficient? Let me throw in the word exquisite in there or atrocious, right? And few, right? So it's like one word replies because I'm just trying, like, I don't have time to respond with thoughtfulness, but I still want the algo to see that I'm engaging. So it became a thing, right? So it's, one time I had somebody DM me who said, how can I be as successful and autistic as you? And I was like,
typo?
It's like, dude, it's an act. Like, and it works, like it or not. Like I go to conferences and people come up to me saying exquisite few, and then we talk about fasting, and then we talk about markets, and it's like, it's just weird to me. It goes back to the intelligence level and just the attention level. It's like you do what you have to do to survive. I had to do what I had to do to survive to grow an audience in a horrible cycle for my 3 funds on the ATAC fund family side. How do you do that? You have to be loud, entertaining. You have to take on an act to get people's attention. What else am I going to do in the absence of a cycle, the conditions that favor my own funds? People don't get it. So if you understand that.
Few.
Few.
So is this why we're all fucked?
Yeah. Another one of my favorite words, right? You know how many people come up and be like, yeah, no, listen, we're fucked. Let's talk one day. And they end up being financial advisors. And it's like, I don't know, like maybe it's my own humor. Um, Again, it's like why people think I'm a perma bear. It's like, no, dude. It's like, first of all, look around you. Of course, we're fucked. I mean, look at the debt. Look at who's in charge. Look at who's not in charge. I mean, probably the better way to think about it. So it's like
Right.
it's kind of a gag, but some people really take it seriously. It's like, dude, like lighten up. When it's like that quote, right? Like, don't take life too seriously. None of us are gonna make it out alive. Like,
Exactly.
you know.
So you mentioned fasting. You look great. I've done a lot of what you've done.
Yeah, dude, you've crushed it yourself. You look great too. Come
Yeah.
on.
It's so let just quickly, I don't want to go too crazy. Let's talk about the lifestyle change and crushing it and how you do it and maybe give people a little inspiration.
You know, Eddie Murphy with the what were the two comedy shows he was well known for in the late 70s, early 80s? I'm trying to
Oh,
remember. You know what I'm talking about?
his specials, yeah.
Which were like he was at his peak, right? He was very good at going full circle with the jokes. Like towards the end of the set, he'd reference something from earlier in the set as part of the new joke, right? And I feel like we're about to do that here because I go back to how we started the conversation, which is in our business, you can't draw the line between skill and luck. You can't control the value of your portfolio. So here I am going through this nasty cycle with my ATAC funds because of treasuries, which again, I'm optimistic that's about to turn. And I think deregulation, oddly enough, is the catalyst. And it's like, all right, well, I can't control what's happening. What can I control? I can control my health somewhat. Literally, that was what happened. I had a flip in my switch, got flipped in my brain.
You control your lifestyle, your
Control,
habits.
yeah, you're right. You control, it's like where you can draw a line between your effort and what you see in the mirror. Right? Literally, it's like as raw as it gets from that perspective. So I said, all right, let me. So I started learning about fasting. I actually like learned about the science, oddly enough, of not eating. I know that sounds strange, but there's certain biological things that happen. So yeah, no, I lost a bunch of weight, 100 pounds at my deepest. Have gained back obviously because I'm doing a lot of training
Right.
in the gym and exercising and trying to get the muscle side and
Yep.
being very aware of that. But it's I think with hindsight, and I have no problem saying this, and anybody that would judge, let them judge. I have no problem with it. I think I probably went through with hindsight some degree of high functioning depression. How could I not? I go from my mutual fund being up 72% to this is my moment. This is my career breakout. Launching two other funds, thinking I'm diversifying with a commonality still of treasuries, and I get round tripped. Right? So it's like, how could I not go through a form of high functioning depression in that? I look at myself in the best, like I must have. That's why I was gaining so much weight. It was comfort food. They call it comfort food for a reason, right? So I had to change it. So I took it very seriously. Learned about peptides. Learned about how proper supplementation, like I like properly like a nutrition from a nutrition standpoint. So am I done? No, but I think you also have to have that mentality to keep being healthy, right? Because the moment you're done, you start saying, I'll have a cookie here and there.
Did you have help, outside help?
No, I mean, so it is just my mentality. I'm fortunate that I think in the industry, those that know me know that I'm a very hard worker. So I basically just turned that hard work into working on myself, right? So, but if you were to look at my YouTube algo on the homepage, every morning it's like a bunch of videos by David Goggins and Alex Hormozy and like all these people that are like the just stop whining, just do it type of mentality, right? Stop
Did you
thinking
read
about it.
did you read Peter Attia's book, Outlive?
No, but I'm a big fan of a lot of his work. Right, and I listened to a lot of his podcast. I actually tried to have him on Lead Like Life. I was back and forth with his booker on that. Um, Look, I think it's a cliche term, health is wealth, but I got to tell you now, I see it and I feel it. And as much as I'm dealing, which is very hard, by the way, mentally, with other people in the industry who are very successful fund managers, product developers, who are making millions, I'm not. And that hurts because I know how hard I work compared to a lot of people. I know what my efforts are. And to see so many other people being more successful than me, that used to hurt me a lot mentally. But then I look at how they are living their lives and I look at their physical state and I look at just they don't look healthy. It's like who's the one that's really wealthy here? Like I know it sounds cliche, but I really have that mindset now.
Yeah, we should talk more about that offline
Let's do
because
a podcast on that. Why not, man? I know
yeah,
same thing.
I gotta have my guy Phil Perlman on. He's my coach.
Yeah.
He's all about fitness alpha, and he was instrumental for getting me straight and eating right and fasting, and taking care of myself. So
I don't know if you, I'm sure you've seen that. There's this index that tracks companies where CEOs are known to be very active in terms of their lifestyle. So it's literally like, it's screening for CEOs that are fit, right? And making that's the portfolio of stocks. That portfolio has outperformed as a stock portfolio, almost everything consistently over time. And there's a logic to it. The more fit you are, the more respect you get. The more respect you get, the more doors are open. The more doors are open, the more chances you have to close. Like, there is something to the idea that if you are doing something which other people are not doing and they can see that it's hard, it just gives you an advantage instantaneously against all competition.
works for the family too.
Yeah. Yeah.
All right, man. I'm gonna let you go. Really appreciate you coming on the show. Thanks for joining me here. It's been fun chatting, catching up. I think we'll probably have to do this again. So I'll sign off again. Jeff Hirsch for WealthWise and Biz Talk Today TV. Wherever you stream your podcast, we're on YouTube, Spotify. For more information on me and what I'm saying about the market, go to stocktradersalmanac.com. And we'll see you next week. Thanks, everybody.